Now, and we talked about three different stocks last week, Noah: ABX, Biogen, and US Steel. Just go ahead and pick one of the three: ABX, BIIB, or X, and let's take a peek at one of those. Now, and add the implied volatility indicator in here. Probably at the bottom would be fine. The old implied volatility. Thinkorswim is such a dynamic tool, guys. I really like it. And you'll notice, okay, volatility is at the bottom, and we were discussing playing the volatility into earnings. And if you remember this from last week, great. If you weren't here from last week, that means you're brand new, and let's welcome all of our new members in here. We do it once every show whenever it randomly clicks in my head. Everybody say welcome to our new members, right? Yeah. All right, good. And let them know they're on the best team ever, and that they're in good hands. Okay, so Noah, one thing I want to do here is I want to talk about, after you build the trade, how to manage it. And so let's build a hypothetical here with either a risk profile or the trade tab. I know we had some strikes from last week on ABX. I don't know if those actually are still down there at the bottom. There's your trade right there. And there are two different positions, okay? And one of them is a call position and the other is a put position. So, and guys, tell me what that picture looks like. I gotta ask you. You always want to know what the picture is, because a picture is worth 1,000 words. A little bit like a hammock, a little bit like a smile. I know it's a big phrase, but we always call these bi-directional, because you can make money if it goes up, and you can make money if it goes down. Let me ask the class, and this will be a quiz here. How do you lose money? How do you lose money? Because there's risk in everything. If it stands still, doesn't move, and the volatility does not build, you will lose money on the position. Now, you'll notice at the bottom there is a maximum loss. So one thing I always want a trader to understand are the components of a trade. Noah, walk me around the risk graph a little bit here. Kind of explain what you look at.
But yes, $0 is the break-even point, and so here you've got a couple things you're looking at. Notice you've got the $17 call, the $16 put. Here are those strike prices. You can see that's where the graph bends. You have your break-even point if it runs to the upside at expiration, your break-even point if it runs to the downside by expiration, and then right now you have the current price of the stock sitting right there, and there's a current break-even point to the up and downside. That's based off of today's time value, today's volatility measurements. Today's pricing is what that purple line is measuring is the current, and you can play around with that. You'll notice that this date down here is the current date, and up here is the expiration date. And so if I wanted to think forward in the future in time, I can play with that calendar and see what time decay does. And then you can use. They also have a little volatility tool here, which is kind of hidden. It used to be more obvious, but they've hidden it down here underneath that little toolbar, I believe. And when you click on that, it opens up a volatility adjustment. And you could say, well, what if volatility rose 5%? And, volatility rose 5%. You watch the purple line will pop higher. That's the idea in this particular strategy, is we believe that volatility is going to rise and that prices will move up or down. And so, time will pass, and if we factor in the time decay, every day that passes, that purple line drops back down. So it's volatility essentially racing against time, and because earnings is on the horizon, we suspect that volatility is gonna increase higher more than the time decays out.
There's a couple things here, and leave all the drawings up here. I like it a lot. Number one, and I want you guys to highlight some of the key features. Number one is you have to know the dates measured, okay? There's a purple or pink line, whatever color you want to call that, and then a bluish line, right? They're measuring how much money we'll make or lose at different prices on different dates. Now, down on the bottom, Noah has the date set to 10/9, right? Up above, we have it set to 12/16. So usually this is called an at expiration risk graph. Type in at expiration risk graph in the chat. And Noah, up on the top, you'll see where the lines say 1 at expiration. Just highlight that. It's above the graph, I believe. Yep, exactly. So this is the most common form of a risk profile. And let me give you guys a reality check. If you're if you haven't gone through Master Trader yet, this is going to be intimidating a little bit, but I want you to get excited. Because the more you understand about a risk profile, you are going to have more confidence as a trader. And more information is always better. This is an analytical's dream, Gino, an engineer's dream, because then we can model so many different things in and out. The 3 or 4 things that you listed out, Gino, that can impact the price, the stock going up and down, the volatility changing, and the time changing, we don't have to guess how much that will impact our option. We can get a really good scientific calculation to estimate that based on the Black-Scholes model, and that's where risk profiles come in. Gino, you've been mentoring for a long time. How do you teach students how to use the risk graph?
You know, Tim, first off, how many people here are struggling with the risk graph? How many people here are struggling? They're looking at this and they have no clue what they're looking at. You know, you got to step forward, because I know, Tim, I mentor students that are 9 months into their classes and they go, I'm not sure how to read this. And I'm like, oh, no. That's like, you know, it's like Tim said, this is your number one tool as an option trader. And a lot of times people avoid it, Tim, because they're not the analytical type like the engineers. But you still have to learn this tool. So basically, what throws everybody off, Tim, is the numbers, the stock. Everybody pictures the stock price going up, not left to right. And so like Noah can show you there, 13 to 19 left to right, that's the stock price down there. And that's telling you, you know, there's some softwares out there like iVest. If you guys still have iVest, you can turn it so those numbers are vertical and it puts it on your chart. And the main thing to know is this, and I don't know why they don't incorporate this into the software. That 0 line, anything below that is negative. Anything below that is a loss. Anywhere above that is profit. I wish they would shade in red on the graph below 0. I wish they would shade that in like a light red, and they'd shade in green above that. So you'd know what's, you know.
If only I had a software that did that. Oh, wait, I do. It's awesome. It's dynamic trend.
Yeah. There's a couple out there that do it. And it makes so much sense, because they also shade in, you know, like exactly on the line and below, like from 0 to the profit line. So there, you need the stock to be above 18 on the right, which means the stock has to be above 18. So the right is above. Left is below 15, where he put those circles. So anywhere above that, you notice the lines above 0, that's profitable. Anything below that is negative. So you can go forward to like the earnings date, put that in there. You could predict volatility, how much it drops, put that in there. And you can pretty much predict, no matter where the stock is, pretty darn accurate what your profit or loss will be. And decide ahead of time, is this a good strategy or not? Because I'm looking at this right now. Where's our break even? It's like right now, it's right there, like right in the middle, right? But we're going to be in this to what day? What day's earnings on this one? ABX is October 26th. So you can go ahead and change the date, Noah, to October 26th. And watch what this does to the purple line. Now, if we're going forward on the date, this is pretty easy. I always do theta first because it's easy. It only goes one way. October 26th. And it's going to load here. Hopefully.
No, it didn't. It took it off because I'm measuring. I'm not sure why that disappeared.
Yeah, me either. Hit your computer real hard on the left.
Hold on the left. Hold on.
Oh, you're on 2018. You're on 2018.
Well, that explains it. 2018. It's like I just jumped into a time machine somehow. That was pretty cool.
Your time machine worked.
There we go.
Yeah.
So that's the.
By the way, real quick, just because I'm kind of running the high point here, I want you to reset all the drawings for a second. And I want you to go down to a single line, and we'll explain the pink line and the blue line. I love this stuff, by the way, guys. I think even just spending time on a risk graph can be so important. So here's a hypothetical trade we had from last week. And now, and this is the way, because what Gino just did and what Noah's doing is exactly how you use the risk graph. This is what I always tell beginners. If you don't know what you want to measure, you're not going to get any value out of the risk graph. So what I always tell people is ask a question.